Welcome back, and you're watching Buy Now, Sell Now on ET Now, and let's shift focus now to earnings. And you had Happiest Minds also that had come up with their earnings. If you look at the constant currency revenue growth, it was about 2.8% on a quarter-on-quarter basis. The EBIT margins have come a tad bit lower on a quarter-on-quarter basis, 21.7% versus 22.8%. And as you can see, the stock is actually at the day's lowest point. Let's bring on board the management of Happiest Mind to talk about the earnings for the quarter gone by. We have Mr. Venkatraman Narayanan, who's the Managing Director and CFO, as well as Mr. Joseph, who's the Executive Vice Chairman and the CEO of Product Engineering Services at Happiest Mind. Very good morning to both of you, gentlemen. Thank you so much for joining us on ET Now. And let's talk about your earnings and the numbers. The 9-month, if you look at the 9-month revenue run rate, it has been around 26%, and this is against the guidance of 20 to 25%. Will it be fair to say that you will beat your guidance?
Yes, the expectation is that we will beat the revenue guidance or meet the revenue guidance for sure, and also the EBITDA guidance of 22 to 24%.
Okay, Mr. Venkatraman, once again coming to you. Now, despite the operating leverage, your margins have slipped this quarter from 23% last quarter to 21.7% this time around. Could you call out what impacted your margins and how do you see them going ahead?
First is our margin guidance was 22 to 24% of EBITDA. We are at about 26+% right now for the 9 months, and we are at 26% for the quarter. So if you look at it at the EBITDA level, we've been pretty much there vis-a-vis previous quarters and the previous year. As far as looking forward, our guidance, we will hopefully hold it to the same 22 to 24%, primarily because, like I've said in the past, we would like to invest into sales, capability building, and maybe even into customers as required, which is why we keep that room of about a couple of percentage points, and we are still not changing our margin guidance to upwards of 25%, even though we have done that for the last 10 quarters in a trot. With the cost front, on the cost front, people cost can be expected to drop a little in terms of the increase. The increase can be a little bit more moderate compared to what we have seen the previous year, primarily because of the demand situation and the attrition situation. But we also could see, some more moderation on the exchange rate. Last year, whatever cost increase was there, we could defray quite a large part of that through the favorable exchange rate that we had.
Right, Joseph, let's talk about the client conversations. If you could tell us how it's trending with regards to what sense are you getting with regards to the cancellations, client budgets, or even delay in decision making?
So I think what we've seen is, December was a time when the clients went through their budgeting cycle, and they've taken a careful look at their priorities and projects. And what we are seeing is that they're prioritizing initiatives that have either a strategic or immediate or quick return, and making sure that they're not releasing the entire budget right up front. So we've not seen any cuts, but they're sequencing their spend and not giving the entire budget to the owners to make sure that the money is spent in a very judicious manner. So I would say there's a cautious optimism in the market, because if you really look, the inflation rate has come down without really impacting the job market much, which shows that hopefully the soft landing that we were talking about should be possible, and that the Feds may moderate their rate hike. So that's what I'm gathering from meeting with customers. But everybody is keeping a very close watch on macroeconomic conditions to make sure that they can act quickly if required.
Okay, coming back to you, Mr. Venkatraman. So you talked about the acquisitions as a lever. While you can't give us specifics, tell us which geographies, capabilities, or size are you targeting for acquisitions?
We are reasonably confident of closing something soon enough, because we have a reasonably strong pipeline and we are in discussion with a couple of companies, but nothing where we have signed on the dotted line. And unfortunately, we're not allowed to disclose until we sign, because things can go either way. So I would say watch this space is what I would say, but we are consistently looking at companies. We've had successful attempts and reasonably unsuccessful attempts in the past, and so being cautious about making a disclosure on that front. As far as companies that we are looking at only digital services companies with a strong offshore presence or an India presence. So essentially, we are looking at the India, US axis, India, UK, Europe axis, anything with an offshore presence, because a company with an offshore presence gives you that benefit of long-term customer relationship. At least that's what we have seen. And also it's easier to, acquire and also integrate.
All right, then, gentlemen, we leave it there. Thank you so much, Mr. Venkatraman, as well as Joseph, for joining us on the show to talk about your earnings. And with that, we are out of time on this edition of Buy Now, Sell Now. Goodbye from Srishti, myself, and the team that put the show together. Thank you so much for watching.